So, profs, we are looking at the adjustment to final account. What we saw, or what we have been looking at, is just how to prepare the financial statement when you are given a trial balance. Now, it goes beyond that because sometimes you would have to do some further calculations or workings simply because errors are bound to happen. The accountant is a human being and will definitely make mistakes. Sometimes you even forget to record a particular transaction, or in the course of doing your addition or casting the figures, you may make mistakes. Now, these mistakes are most often revealed at the end of the period. When it is brought to light, we need to make adjustment to the final account. Okay, so let me give examples so you can get a picture. So we may have recorded sales of 20 million Ghana cedis, but at the end of the year, we'll get to know, or there will be a revelation that, well, some amount of 1 million credit sales was not recorded in the books. Another example could also be that we made a payment of 5,000 Ghana cedis for rent, but it so happens that this 5,000 Ghana cedis is not just for 1 year, it's for 2 years. Okay, now you appreciate that the trading profit and loss account is prepared for 1 year. So where you have made payment for 2 years and you are preparing an account for 1 year, you cannot include all the 2 years. That will go against the principle of matching, okay, and the accrual concept. So it is better you only apportion or allocate the expenses and revenue for a particular period when you are preparing the final account of that period. Is it making sense? You can also have a scenario where the owner might be taking something for personal use, and that will be brought to you and you have to adjust. So that's the whole idea of adjustment. But for your level, there are some adjustments we'll focus on. We'll not look at every adjustment. Okay, so let's first define this adjustment, and then so someone should read for me what is on the screen. Prof. Stacy, can you do the reading?
Adjustments to final accounts of a sole trader. Adjustments are corrections of further workings that are effected in the final accounts of business at the end of balances.
Okay. Thank you. So, like I've hinted, adjustments are corrections or further workings that are effected in the final accounts of the business. Okay. So it could be further subtractions or further additions. Again, when you are doing adjustments, you pass closing entries. What I mean, or what we mean when we say closing entries, is that these are entries made at the end of the period to transfer balances from temporary account to permanent account. So if you appreciate what we have been doing, you see that the sales account, purchase account, return invoice, all the other accounts, at the end of the day, they find themselves in the trading account and the profit or loss account. So then how do you do that? You pass closing entries to remove the balances from these accounts, i.e. sales, purchases, or whatever account, and you transfer them to the trading account or profit or loss account. So technically, let me demonstrate that. technically, if you had a sales account like this, where you have recorded sales for the period. So let's say, let me put in just 2 transactions. When we sell goods, we credit sales. Let's say you have sales for coffee, you have sales for Ama. There's 100 for coffee, then 100 for Ama. You know, when you are extracting your trial balance, you balance with carry down, brought down, and you take it to the trial balance. Technically, at the end of the year, you need to pass a journal entry to transfer these balances to the trading account. Okay, so it no more becomes carry down, brought down, but transfer to what? The trading account, a total of 200. So the sales for the year is transferred into the trading account for that. And you do so by passing these closing journal entries. But at your level, you are not going to be preparing or opening or doing these closing entries. Most of the things you'll be doing will be the further workings, that's the additions and subtractions. Okay? But then you needed to appreciate what closing entries are. So now let's begin to look at some of the adjustments that we are supposed to look at. So Professor, there are about 10 of them, 10. Okay, so quickly, let me take you through them. We take each of them into details. So the first one is accrued expenses. Accrued. I'm sure you have heard these things because during the phase of the balance sheets, I mentioned few of them. Accrued expenses, prepaid expenses, income owings, income prepaid. Then we have goods withdrawn for owner's private use, cash withdrawn for owner's private use. The proprietor's private expense charged to or charge against the firm's expense. We have provision for depreciation, bad debt and provision for bad and doubtful debt. Then finally, interest on loan. So 10. If I separate the provision from the bad debt, then you can have 11. Right? But they are all similar concepts, so we'll look at them together. So let me go over again for those who want to notice. The adjustment you are supposed to know as an accounting student at this level: accrued expenses, prepaid expenses, income owings, income prepaid. Now, the income prepaid, I prefer to call it income received in advance. And then have the goods withdrawn. Now 5, 6, and 7 can all be referred to as drawings. That's the owner taking something for private use or personal use, or adding his or her private expenses to that of the business. Okay, so they are all drawings here. Then you have provision for depreciation, bad debts, and provision for bad debts. Then interest on loan. Okay, so let's pick the first one, which is accrued expenses. Accrued expenses. Prof. Nicole, can you do the reading for us? Accrued expenses.
Yes. Accrued expenses refers to an amount of expense that have been incurred but not yet paid for. It is also called expenses, due, outstanding, unpaid, owings. Yeah. Accounting treatment in the final account. Profit and loss account. Expenses due is added to the expenses paid and the results debited. in the balance sheet shown as current liability.
Okay. So, professors, when you hear accrued expense, it refers to any amount of expense that has been incurred but not yet paid for. So look at the key terms. You have, or the business has incurred the expense or the expenditure, but no payment has been made for it. You can also refer to accruals as balances due or outstanding or owings or unpaid, or let me add the other one, or in arrears. They mean the same thing. Arrears, outstanding, unpaid. So anytime you see accrual or accrued, we are simply saying that the business is owing. Okay? So can you give an example? A practical example where you can conclude that this is an expense accrued or prepaid. Anybody to try? Feel free, say anything. We are learning, so nothing is wrong, right? Yes, I have Joris. So Joris, let me begin with you, then Abeko will come in.
So it's maybe when a business borrows goods from, let's say, suppliers.
Okay, so when
we pay later.
Yeah, we buy goods and we don't pay, right? Okay. But here I would want us to focus specifically on some of the expenses that we have known in the profit and loss account, i.e., administrative, general, selling, and distribution expenses, right? The example you give is very true, but you see, it's linked with trading. But trading looks at your purchases, right? So when you purchase goods from your your suppliers and you don't pay, we term that as credit purchases, which is actually an accrued expense. Okay. And when we move further, I'll come back to that to make you appreciate why your purchases is a combination of the ones that you have paid, as in the cash purchases, plus the ones that you haven't paid, i.e. the credit purchases, right? So, Amuzu, that was a good example, but linked with the trading account purchases, right? Okay. I want one linked with any of the expenses in the profit or loss. So, I don't know if you were going to.
I was going to say the same thing about like buying without paying.
Okay. Well, you could have told me that, occupying a building you have not paid rent for, or occupying a store you haven't paid rent for. You have occupied a room for 12 months, you haven't paid, or even 3 years, you haven't paid. Right? Or insurance, you haven't paid your insurance premium, or your electricity bill. I think the electricity bill is when we're using the postpaid, we use the light without paying. So these are accrued expenses. Now, how do you adjust for these in the final account? And that is the bone of contention. Okay, that's the bone of contention. So let's look at it. We are saying that in the final account, the first place you think about is the profit or loss account. The profit or loss account, what do? We are saying any expenses or any expense due or outstanding, right, should be added. So if you are told in the additional information that there is some rent we haven't paid, if it belongs to that period, please add it. Okay. So for example, the whole year you are supposed to pay rent of, let me put some of these things on the board so you can follow. Let's say you go for a building, you are renting a building and the total rent is 1,200, which means every month you are supposed to pay 100. Okay. So this is your total rent for the year, but you have only paid 800. So can you tell me how much is unpaid? I think this is a simple mathematics. 400 is not paid. So to adjust this 400, which has not been paid, we say in your profit or loss account, you add this 400 to the 800 so that you get the total expense or rent for the period. Okay. And since you haven't paid this, when you go to the balance sheet, you would show it as a what? Current liability. Does it make sense? If not, please ask any question that you may have.
So it's like, can you explain it again?
Okay, so let's do it this way. What I've said so far, how do you also get it? What is your understanding of what?
Tell me. To me, what I understand is like about the accrued expense that like you are owing someone, like you have used up the resource that they gave you, but you have not paid for it. But the one that you are doing inside the expense account, that like I'm not getting it. No.
You are looking at this account. Oh, hold on! Don't look at the account yet. At least I haven't gone there. So why are you looking at it? Please.
Okay.
So get it from how we are starting. You see, we have defined it. We are looking at how you treat it in the profit or loss account and balance sheet. Then we'll come down to the account you are seeing down here. Okay. So don't confuse yourself with some information we haven't got into.
So is the expenses due like the amounts that you are owing they have not paid?
Exactly.
So why is it added to this one? The expenses that you have paid.
So let me ask you a question. If you let me use your school fees, right? Because then your school fees is an expense to you. So as a student, you are supposed to pay school fees. Let's say for the term, you are supposed to pay 2,000 Ghana cedis. But you have only paid 1,500 Ghana cedis. So how much fees do you owe, or do you have as arrears?
That is 500.
Good. Now, if you are preparing your account for the term and you write amongst your expenses school fees, what figure are you going to show in that account as your total fees for the term?
Say 2,000.
How much?
2,000.
2,000. Good. So that 2,000, is it not a combination of the 1,000? Hold on. Is it not a combination of the 1,005 you have paid? Okay. The 1,500 you have paid plus the 500 you haven't paid. That is all that we are saying. So you would technically add the part of the fees you haven't paid to the one you have paid to get the total fees expense for the term. That's the point we are making. Does it now look a bit understandable?
Hello, sir.
Yes.
So please, I couldn't hear your voice. I couldn't hear you when we were talking the last one. But sir, please, I understand now.
You understand now? Okay. So I'm saying that since you indicated that you would write 2,000 as your total fees for the term, in accounting you have to show that, okay, I have paid 1,005, but I'm owing 500. So what did you do to the owing? You added to what you have paid. So on this basis, then we can confidently say that anytime you are owing expenses or an expense is accrued or outstanding, you add to the one you have paid to get the total expense. Okay. Any other question? Jane, are you following us?
Yes, please.
Okay. So we're looking at the adjustment and we are on the first item, which is accrued expenses, where the business might be owing certain expenses, right? As in, they have incurred the expense, but they haven't paid. So we are saying in your profit or loss account, you have to add that expense you haven't paid because it belongs to the period, just that you haven't paid. Okay. And then in the balance sheet, that portion will be shown as a current liability. Okay. Now, I want you to take your eyes off this T account because this T account is what you do to do the workings, right? But for now, let's get the understanding, then we'll come back to this T account, okay? Let's go to the second one, which is prepaid expense. Prepaid expense. One of you should read for me. Janet, I think you do the reading for me. So Jane, let me hear you.
Prepaid expenses. This refers to an amount of expense paid in excess of what has been incurred. It is also called expenses paid in advance. Accounting treatment in the final account. This should I continue?
Okay, I think, yeah, hold on for me there. Okay. So thank you, Jane, for that reading. So as you rightly heard Jane read, these are expenses paid in excess of what has been incurred, right? So in simple terms, it means that the expense was say 1,000, but we made payment for 3,000. So we have paid in excess. It's like going to rent the building of a landlord. The rent for the year is 1,000, and then you give the landlord 1,200. So what have you done? You have paid in excess of what the actual expense is. Again, like your school fees, the term you are supposed to pay 800 cedis, but you go and pay 1,500. What have you done? You have paid your school fees in advance. So the question is, and again, let me use this school fees thing because then you appreciate that scenario. So if your fees for the term is 1,000 Ghana cedis, but you have actually paid 1,500. My question is, when you are preparing accounts for that term, how much will you put in your expenses as school fees expense? The fees for the term is 1,000, but you have paid 1,500. If you are preparing an account for that term, how much would you put as school fees expense? Who is going to attempt this? Prof. Nicole, would you give it a try?
Sir, please, I'll place 1,000 over there.
You put in 1,000.
Yes, please.
Okay. But you have actually paid 1,500. So why not 1,500?
Because the school fees is 1,000.
Okay, because the school fees is 1,000. Okay. Prof. Fifinati, do you have anything different or you agree with Nicole?
Yes, sir.
You agree with her? Okay. So that is true. You put 1,000 in your account, but in accounting, if you put the 1,000, that does not give us the clear picture. So the clear picture is that you will tell us, I've actually paid 1,500. Okay. But 500 is not for this period. So you subtract. So minus 500. You subtract the prepaid amount. This is how you show it. So the net effect will be equal to what you said, that you put in 1,000. But you need to demonstrate or show this working for your users to know what actually happened. Right? That is why you are seeing here the accounting treatment in the profit and loss account. It is deducted from the expense paid. Okay? It is subtracted as I demonstrated. And in the balance sheet, that 500 actually is a current asset. It is a current asset. Why is it an asset in the first place? Because these are monies that we have paid but have not enjoyed any service or product. So it's still our money. That is why if you pay your school fees in advance, you can go and claim the excess or the difference because it is your money. Unless maybe you enter into the next term and then you also spend that 500 school fees you paid, right? So that is for expenses prepaid. I hope it is clear to all of us. If you have a question, you can ask. No questions? Okay. So we are going 10. We have done 2. Okay, and the first one is accrued expense. What we have seen is that you add accrued expense in the profit and loss account. In the balance sheet, it's a current liability. And then for prepaid expense, you subtract. And in the balance sheet, it's a current asset. You can write these sums, but that's all you have to remember. So we are done with the expenses. Let's go to income. Income. So we have accrued income. Prof. Emmanuel, can you read for us? Please do the reading for us.
So, accrued income. It refers to an amount of income that have been earned but not yet received. It is also called income due, outstanding, unpaid, owings. Accounting treatment in the final account. Profit and loss account. Income due is added to the income received and credited into bracket added to gross profit. The balance sheet, the accrued is shown as a current asset.
Okay, thank you, Lima, for that. So you see, accruals, as we saw, it seems to become a household care, right? So here it means that the income has not been received. The business has earned the income, but has not received it. A typical example, now let's do the reverse of your school, right? Your school sees your fees as income. So if students haven't paid their fees, they've gone through the term, but they haven't paid their fees, the school will see that as accrued income, income that has been earned but not received. Okay. So if the school is preparing its account for the term, it is going to add the amount that has not been received from the student because they have earned it. And that is why they can chase you for that amount, because they have taught you for that term and you need to pay. So income accrued is where the business has earned the income but hasn't received any payment for it. The accrual concept will say that even though you haven't received any money or cash for it, in as much as you have earned it, you have to add it. That is why in the profit and loss account, it is added to the income received. Okay, and it will be treated as other income, right? We know how other income is treated in there. Then in the balance sheet, this is a current asset. It is a current asset. You have earned it, just that you haven't received money for it. So you show it as a current asset. Okay. Let's look at the other one, which is the prepaid income. Okay, prepaid income. Joris, can you do the reading for us?
Prepaid income refers to an amount of income received in excess of what has been earned. It is also called income received advance, accounting treatment in financial accounts. Profit and loss account. Income prepaid is deducted from the income received and the results credited to profit and loss added to gross profits. Balance sheet. The prepaid income is shown as a current.
Okay, thank you very much. So here you appreciate that the business has received the income in excess of what they actually earned. So again, if we take your school as the business, then if any student pays fees in advance, what it means is that the school has received that income in advance. So if for a term, right, for a term, the students are supposed to pay a total of 20,000 Ghana cedis. But then the school has received a total of 22,000 Ghana cedis school fees. What it means is that the school has received 2,000 in excess from the student, and that is prepaid income, or the school has received some income in excess or in advance. So we are saying when the school is preparing its account, total school fees income for that term would be, yes, we have received 22,000, but 2,000 is an advance payment, so we subtract. That's what the school would do. The school cannot add that 2,000, so they have to subtract it and come to the final figure, 20,000, which actually represents the income or the school fees income for that term. So this is what we mean when we say any income prepaid is deducted or subtracted from the income received. And in the balance sheet, it is shown as a current liability. It is a liability because the school cannot claim the 2,000 as theirs. It belongs to the student because that 2,000 is not for the term that has been completed. Okay. Any question, professors?
Sir,
Yes.
I don't understand why it has become a liability.
So, Agbepo, let me give you a simple scenario. You are a shoe seller, right? And then you receive money from someone who is coming to buy your shoe. Okay, so let's say the cost of the shoe is 200 cedis. the person gave you 300 cedis, and you, Abeku, you have produced the shoe which is 200 cedis to the person. My question to you is, when you are preparing your account, how much will you show as income you have made on selling the shoe? Are you going to put in 300 or 200?
Sir, this sir, from what I understand, no, it's like the person that I sold the shoe to, he has added extra money to buy this one for me. So if we add it, I don't understand how it become a liability, because I thought that, like, I was saying cash is an asset. So since you have more cash than you already expect, I thought like it will still be an asset.
So until the contract terms says that he is giving you a bonus, that money is not yours.
Sir, but it is with me.
Yeah, so the person paid in excess. You see, sometimes people make, okay, it's like, okay, the shoe is 200 cedis, but he gave you let's say he gave you a check of 300 cedis because he has already written a check of 300 cedis, and he didn't want to write a new check, so he gave you the 300 cedis, right? And there was no mention that this extra money is for you or bonus, as you are seeking to allude. Okay, or let me not use the shoe. You are a landlord, you have a building, and then a tenant comes. The tenant is supposed to pay 1,000 cedis for 1 year, right? And then the tenant pays for 2 years, which is 2,000 cedis. Technically, if you are preparing your accounts for that particular first year, would you put in the total 2,000 you received, or you only put 1,000 as the rent income for that year?
So I'll put the 1,000, but I'll say that.
So you are going to put 1,000 because that is actually, and you see, it will be at the end of that year. So if, say, the person is going to stay in the room for 2025 and 2026, but we are in 2025, at the end of 2025, you can only recognize the 1,000 because then the person has used your building for that year. So you can claim that amount 1,000. But the 2026 1,000, you cannot claim it because the person has not stayed in your room for 2026. And he or she can decide that, well, I'm not staying in your room again, so give me my advance money. And it happens where tenants go to landlord or landladies to ask for their advance payment because they are not using the room again. Let me use another example which may be, relatable to you. You have a bicycle, and a friend comes to give you, say, 20 cedis to use the bicycle. Now, if he uses the bicycle for a day, he only pays 15 cedis. Now, this person gave you 20 cedis and say, you let me use the bicycle. When I come, then if the person brings the bicycle or uses the bicycle for a day, you can only claim the 15 cedis relatable to the 1 day charge. So the extra 5,000, it's not your money. So it's a liability. The money is with you, but it's not yours. So that's why it's a liability. You can't claim it as your asset. It is somebody's money sitting with you. And until the person uses your product or benefits from your service, you cannot claim that money as yours. That's why it is a liability. So it's not extra bonus as you seem to analyze. Does it make sense?
Thank you.
If not, then like this DSTV subscription, you know that some people can pay their subscription for like 1 year at the beginning of the year. Then DSTV will say that it's extra bonus. So they will take all that money. Then when January expires, they put the DSTV subscription off. Do you think the subscriber will be happy? No.
That's like you keep the money as an asset, then you used to go into the next this one.
No, so until that period has expired, you can't say it's your asset because you haven't earned it. So DSTV would only acknowledge that part of the money they have provided the service for. So if the person paid for 12 months, in January or at the end of January, DSTV can say that, oh, we have earned the January subscription. But they cannot add that of February, March till December. No. So as they now move into February, as the person is enjoying, at the end of February, they also acknowledge February. All the outstandings, okay, all the amounts that the person has paid in advance, they cannot claim that it's their money. That's why they keep it. And as and when the person uses, they now says, okay, now you have exhausted it, so we have taken that money. I think when you even come to some of you do these things, your parent will pay the watch seller for the whole semester, right? If we are using your analysis, then the watch seller should give you just watch for the day and tell you that the extra money is bonus, extra. But no, she cannot do that.
I'm not saying that supposed to be bonus. Like, I don't understand why it is a liability, because the money, like you can just keep it for the person. Like whenever the person can give it to you or
If
her,
you are
but
keeping money for somebody, is it yours? It's not yours, so it's a liability.
so why can't why is it not an asset? Say, but it is, let's say that they drop the money into your bank account, and then they say you be taking care of the child. But it's an asset for you, but you don't be spending it, you'll be keeping it for the people.
No, you cannot classify it as an asset because it is not an asset. It is somebody's money. You just happen to be the keeper of it.
So what makes it a liability?
It's a liability because the person, you owe an obligation to the person, right? The person can decide, okay, I'm no more interested in your product or service. Give me back my money. That is why it is a liability. So it is
Okay, sir.
It is a possible obligation you would have to satisfy. Another example I can give to sort this out is if right now your father gives you 500 cedis, okay, and he doesn't say that, or he say, oh, keep it for me. Maybe because you wash his car, right? So he say, you keep it. When you wash my car, you take it. If you haven't washed the car, can you say that money is yours? No. So until you perform the service or provide a product, that money is not yours, it's for your father. So to you, in your books, you cannot acknowledge or recognize that as your asset. It is a liability. It is seen as you are owing your father 500 cedis until you wash his car. You get the point?
Yes, sir.
So until the business provide the service or the product, that money that they have received is like a loan. So it's a liability. Okay. Well, you can continue the debate with your colleagues maybe later on. Okay. Please, are we okay? The others, Amuzu, do you also have a different opinion? If bring it on so we can discuss and reach a consensus. Stacy, Nicole, George, Janet, Hillary, Fifi. Are you also okay, or you are also confused about something?
It's fine.
Okay, great. So the summary on this is that anytime a business receives money in excess of what they have actually earned, it is a liability. You haven't earned it, right? So before we move on, we have looked at 4. Before we move on, let's see if we can draw some summaries. And these summaries are very important. So Let me come down here. So we have seen 4 of them. The first one is accrued expense. And all that I want you to tell me is how you adjust them in the profit and loss and balance sheet. So let me list them. We have also seen the prepaid expense. We have seen the income accrued or accrued income. Then we have seen prepaid income. So let's go, professors. In the case of accrued expense, what do you do in the profit and loss account? And what do you do in the balance sheet? Let me use BS for balance sheet. So this one, let me see, I have 1, 2, 3, 4, 5, 6, 7, 8. So each and every one of you give me 1. So accrued expense, Agbeko, in the profit and loss account, what will you do with it? Are you now searching for it in your notes? You should have it off head.
Service, I'm not searching for it, right?
Okay,
I'm
then
thinking about it. So it's like an expense.
So what did we say you will do? Do you subtract or add?
So you add.
Okay, so you add to the expenses, Okay. And then in the balance sheet, accrued expense is shown as what? Prof. Nati. In the balance sheet, we show it as what? Oh, something we just saw, you have forgotten. Prof. Nati, do something before you die. Prof. Nati, do something before you die. Prof. Nati, do something before you die. If you can't do something, just tell me, say, I can't do something. Or you can elect somebody to assist.
Joris, help me with it.
Joris should help you. I think maybe his network is.
Yes, sir.
You might take it again. I think it's the network.
I said
Okay, current asset. Current liability. So this is how I want you to remember it, that accrued expenses, you add them to the expenses in the profit and loss account. And then in the balance sheet, you show it as a current liability. Now let's go to the second one, which is the prepaid expense. So that one too, in the profit and loss account, in the P&L, you show it as what? And then in the balance sheet, what do you do? So let me go to the next 2 people. So Prof. Janet, prepaid expense in the profit and loss account, what do we do to it?
This say it is deducted from the expenses paid.
Exactly. It is subtracted or it is deducted. Thank you very much. And Prof. Stacy, in the balance sheet, what do we do?
Current assets.
Current assets. Thank you. So you can keep these summaries in your revision. Makes it very simple. Income accrued. Income accrued. Prof. Nicole, in the profit and loss account, what do we do to income accrued?
So please, it's added to the total income.
It is added to the income. Okay. And Prof. Hillary, in the balance sheets, we show it as what? The current asset or current liability? Oh, I just lost some. Okay. So in the balance sheet, it is shown as a current current assets. Current assets. Then the last one, prepaid income. Again, you subtract from the income, and in the balance sheet, you show it as a current liability. So you see, you can really get summaries from this. You see the accruals, whether expense or income, you add. So in the profit and loss account, we add accruals or we add owings. Okay, accrual is the same as owings, unpaid arrears. So you add them. And then for the prepayment, you see we are subtracting. So any prepayment, whether income or expense, you subtract from the income or from the expense. Okay, but when they go to the balance sheets, they behave separately or differently. But even that, the accrued expenses and the prepaid income are the same current liability. Then the prepaid expense and accrued income are current assets. So please get these things to be comfortable with the adjustments. So 4 down, let's continue to see the others. So the next one is goods taken for owner's private use. Goods taken for owner's private use. Professors, Prof. Hillary, can you read it for us? Goods taken for owner's private use. I'm sure she might. Okay. Prof. Jane, can you read it for us?
Goods taken for honest private use. This refers to value of stock used by the owner of the business for his or her own private purposes. Accounting treatment in the final account. Trading accounts. It is deducted from the purchases. Balance sheet. Added to drawings and deducted from capital.
Okay, thank you very much. So we say when the owner takes goods for private use, you see that this one is not going to the profit or loss, it's going to the trading account. And you are going to subtract it from purchases. So note, anytime you are solving a question and you see in the additional information, the owner withdrew this value of stock or goods for his or her private use, you subtract it from purchases. So when you are lessening your return out was adding carried inwards to the purchases to get your net purchases, you also subtract the goods the owner withdrew, right? And then in the balance sheet too, you treat it as drawings. And we all know that drawings is under the finance by, right? When you bring capital, less drawings. That's what we are talking about. Okay, the other one is when the owner takes cash. So if the owner takes cash, what do? You subtract it from the cash, and cash is in the balance sheet, current assets, right? So you subtract it from that cash balance, and then again, you treat it as drawings, which you subtract from capital under finance by. Okay, now the third drawings is when the owner adds his or her private expenses to that of the firm. Okay, so let's say the owner has his own building he's renting, and then the rent he pays, he comes to add it to that of the business. That is wrong. So in treating it, expenses are in the profit and loss account. So you go there and subtract from that expense. So if it is rent, you subtract from rent. If it is insurance, you subtract from insurance. Whatever expense it is, you subtract. And again, in the balance sheet, you treat it as drawings. Okay. So number 5, 6, and 7 are all drawings. Right? So you can appreciate them being subtracted from the capital under the finance by. But if the owner took goods, subtract it from purchases as well. If it is cash, subtract from cash. Even if he went to the bank to withdraw from the business bank account, subtract from the bank, right? The bank balance. Okay. Now we are moving closer to these bad debt, provision for bad debt, and provision for depreciation. Okay. But before we go there, let me see if I can give you something to make you appreciate what we are doing. So let me check. Particular demonstration. In fact, closing stock is one of the adjustments, but you see, we already know how to adjust closing stock. So if you appreciate, we subtract it from cost of goods available in the trading account, and in the balance sheet, we show it as a current asset. Now, that being said, you should note that any item in the additional information or adjustment is normally done twice, right? You do the adjustment, it affects two things, or it has two effects. So one can be in the trading account and the other will be in the balance sheet, or both of them can be in the balance sheet, or both of them can be in the profit or loss account, or you can have one in the profit and loss and one in the balance sheet. But each adjustment item normally has two effects, so take note of that. So let me see if I can make you appreciate some of these things we are saying. So this is a typical question, how it's going to be structured. They'll give you the trial balance, as you see here, right? And you are familiar with this. They give you the items, right? Then look at the additional information. So you see something like, as for the closing stock we have spoken about, commission unpaid, commission unpaid. Okay. Then you see the provision for bad debt, we are yet to look at that. You see telephone outstanding. You see accrued salaries. So you see all the words we have been using, outstanding, accrued, unpaid, they are coming in here. But it's for you to judge whether it is an expense prepaid or an income prepaid or otherwise, right? Then you have rent was received in advance of this. Okay. Then you see here, the owner reduced 2,000 worth of goods for private use. And that's what we just discussed, when the owner takes goods for private use. And then again, the owner took from bank 9,000 for personal use. So the owner has gone to the bank account to withdraw something for personal use. Now let's see if we can look at how this will be adjusted. Okay. I want you to appreciate before we continue. Let's take the first one, which is commission unpaid. Commission unpaid. How do you know whether this is an income or expense? You have to come to the trial balance. Okay, and locate commission. So if you come into the trial balance, professors, this is the commission, and look at where it is. The balance on the commission is at the credit side. This is telling you that the commission is an income, because income is on the credit side, and the expenses on the debit side. So if this is income, then it means this commission unpaid is income unpaid. And income unpaid is the same as income accrued or income outstanding or income owing. So from our summaries, what do we do with income accrued? We add to the income, and then in the balance sheet, it's a current asset. Let me show you how this was adjusted in the final account. So look at it. Come here with me. This is the trading profit and loss account for that question. And look at it. When we go to other income, see the commission. What is happening there? We took the 10,000 which was in the trial balance, and we are adding the 1,008 which we were told that it has accrued. So we have added it to the income. And in the balance sheet, come and see what is happening here. In the balance sheet, you see under current assets. Look at where I'm highlighting. Under current assets, you see commission was unpaid, being shown as current asset. So that's how you do it. So originally we were preparing the trading profit and loss and balance sheet without these adjustments. Now as they come in, this is how you go about it. Let me see if we can look at the other ones. Now let's keep the provision for bad. Come to telephone outstanding. Telephone outstanding. So let's look for telephone. If you look at it, this is telephone. So telephone is an expense. So there is an expense outstanding. And expense outstanding is the same as expenses accrued or expenses owed. What is the summary about expenses accrued? You add to the expense. And in the balance sheet, it is the current liability. Let's go and see how we did it or how it was done. So in the profit and loss account, under your expenses, you have telephone. You see it. So what are we doing? We are adding the 1,002 arrears or outstanding to the 3,000. Let me go and show you. So you see that in the trial balance, we pay 3,000. And they are telling us that 1,002 is outstanding or accrued. So we are adding the two. That's why we are adding that in the profit and loss and the expenses. And then in the balance sheet, come and see it. Current liabilities. Under current liabilities, you see the telephone outstanding of 1,002 presented here. Okay, so that is how it plays out in the financial statement. Please, questions? Any questions? No question means that you are very comfortable with what we are discussing so far. Okay, I think there was some goods withdrawn. Let me go and look at that one. Some goods withdrawn. Let's see how it was done in that question. So in the question, we're told that the owner withdrew 2,000 worth of goods for private use. So what do we say about it? We say that you subtract it from purchases, right? So look at it here in the trading account. See, this is your purchases. They had return out, so they are less in it. And then less goods withdrawn. So before you get your net purchases, you less any goods withdrawn by them. And in the balance sheet, we say treat it as drawings. So look at it. Under the finance by, capital, less drawings. And you see that 2,000 being added to the drawings to be subtracted from the capital. The 9,000 is the cash, which was also withdrawn. From the bank. Let's look at that one. The owner also took from bank 9,000. That is why we are adding the 9,000. But already in the trial balance, I think there was some drawings there. Let me check. Yes. There was some drawings of 19,000. So you see, we pick that figure and then we add all the adjustments on drawings. So he took goods, he took cash, we add all together. In the balance sheet, we are seeing that. Right, drawings. The 19 plus the 2 goods plus the 9,000 for bank. And then when we go to the bank under current assets, you see that we are subtracting the 9,000 the owner review for private use. So this is how you do the adjustment. Well, for the purposes of not confusing you, I think I would postpone the depreciation, the provision for bad debts, and the interest of loan to our next meeting, God willing, next week. Okay. So let me hold what we have done so far. We have looked at 7 of them, right? So you can revise around it. You can even begin to solve examples in the past question or in your textbooks. Then you bring up any question. Okay. So professors, any question? Well, it is my hope that you appreciate and trust me, in your WASSCE or any external exams or even your end of term, you will not get questions like what we have been doing where you don't have any adjustment or the only adjustment is closing stock. Most of them will come with these adjustments. So please, let's begin to appreciate these things. So, okay, thank you very much. I think we have some 10 minutes more to end the class, but it may not be enough for us to look at the provision for depreciation and that for that. So I'll hold on and adjourn our class to our next meeting. So if there are no comments from you, then I guess I'll pause here. I'll share the reading material with you and also try to get the video as well so that you can view it. Until then, it's going to be a bye-bye from me. So take care of yourselves. Props, I'll see you next week. Okay, Amos, go ahead.
So please, in the manual, are there questions on this?
Yes, I think there's one question, in the learner
similar questions.
Yeah, there's one question there where they have some of the adjustments there, but not too many adjustments. I think I have the question on the WASSCE they wrote this sentence, which they had a full question on these things, trading profit and loss account and balance sheet. So if I see the document, I'll share with you so that maybe you can begin to appreciate. Okay. So, profs, thank you very much. I'll see you next week. Have a nice day. Bye-bye.
Bye, sir.